Welcome, everyone. I think we have a great audience today. I think some close to 300 people attending from different walks of life. Thank you. And before I could introduce everyone, maybe I thought a better way of doing this could be that we could just walk through the different themes in delisting that we are looking at and how we sort of thought about this well-rounded panel, and introduced each panelist in that regard. I think delisting, unfortunately or fortunately, has been a rather esoteric topic, testing all limits of corporate governance, not just in India, but I think across globally. Depressed markets and stock prices have obviously now resulted in mushrooming delisting propositions, not just in India, but also US, UK, Singapore, etc. I think particularly in the Indian context, delisting is way beyond just the procedural aspects of delisting. I think it tests the substantive aspects and it tests the philosophical aspects as well of governance and pricing. So we thought, why not have a session which analyzes the entire ecosystem or the life cycle of delisting. And for that, I think we felt that we should have experts on every topic to share their views. I think the first theme that we'll discuss today in greater detail is about the commercial drivers. What really causes or what is the incentivization for delisting? Is it absolute control over the company? Is it operational freedom? Is it in situations that the listed company is not really reflective of the intrinsic value, or whatever, what are the commercial drivers that is sort of driving so much interest in delisting? On the attendant aspect, how do you arrange for the financing for such delistings? Unfortunately, in India, there are significant challenges in terms of banks and NBFCs giving funding for such kind of capital acquisition, and therefore what you are left with is really either the special situation funds or sometimes private equity funds. The special situation funds tend to be expensive, structures tend to get complicated, and if it's a private equity fund collaboration, there's unfortunately a risk of the private equity fund getting qualified as a person acting in concert and therefore being stuck in the rigmarole of making an open offer, and not really being able to get out of a collaboration if a delisting fails and being stuck in the open offer process. I think the third, so I think on this theme particularly, we'll have Anshul Vain. Anshul is Managing Director of Citigroup. He's had 15 years plus of experience in Mumbai, New York, across asset classes. He's an MBA from Chicago Booth and also an engineer from IIT Technology, from IIT. I think the other theme that we'll be discussing today, which I think tends to get extremely interesting and complex, is the governance perspective. Now, in many ways, delisting in India and the sort of pricing mechanism, which is the reverse book building process, is pretty unique in the Indian context. And I don't think I would be incorrect in saying that it's really the quintessence of shareholder democracy. The shareholders decide what price works for them and what doesn't. And this is probably the highest degree of democracy that you can offer. Yet even after all of this, there's a perception that it may not be the best pricing methodology. And to give a perspective, I can only remember Plato's Republic, which talked about democratic institutions, and Plato in that book said that democracy, for it to be successful, needs the concept of philosopher kings, which means that each of the person who's voting is also eligible to be a king. That means essentially everyone should be equal. And the challenge is that in a country like India, where shareholders are not so literate, they do not have the same degree of knowledge and information, despite the fact that well-reputed proxy advisory firms like Hetal, etc., are helping them, they are not at the equal plinth or at the equal platform. And therefore, you cannot really have equality between unequals. And somewhere, I think, despite the flexibility or the democratic institution that we are trying to build up, it doesn't quite work. I think, on the other hand, in governance, and this will be an interesting debate which will come through, is that at one end you have a situation where the regime promises absolute shareholder democracy, shareholders decide their price, and if that price is not acceptable to the promoter can pretty much suggest a counter price which bases itself on the book value. Whether book value works for every industry or not is a question. For instance, in asset-light companies, a book value threshold pricing may not be accurate or may not be an adequate benchmark. I think the fact that the fairness threshold, which is very clearly set out under the Takeover Code, where independent directors are required to give a well-reasoned recommendation on a takeover offer, or even under the Companies Act, under the merger rules, where directors, it's required to be disclosed which director voted in favor, which director voted against. None of those fairness thresholds have actually been prescribed here. And I think a question which we'll discuss in greater detail later will be that if the law is intentionally silent, then are we somewhere being over-prescriptive with the pricing methodologies, or prescribing that, this price is not fair and that price is not fair, and, complicating the whole pricing methodology? I think that is where we'll bring in Hetal. Hetal is President and Chief Operating Officer at Institutional Investor Advisory Services. That's a proxy advisory firm and pretty much the custodian of the interest of retail investors and also advisors to some of the larger institutional investors who are investing today. Plays a very important role, considering that stewardship responsibilities and institutional investors' responsibilities have been codified. I think the governance framework will be a very important aspect. Talking about governance, we'll also have, we'll also analyze the international comparative law perspective, where I think we'll bring in Umakanth from National University of Singapore. Singapore just about last year amended their regulations to provide that the pricing need not just be reasonable but also be fair, and it incorporated the entire concept of a fairness standard and an international financial advisory board to come and opine that whether the pricing is fair or not. So I think with Umakanth, we will talk about the international comparative law perspective. Umakanth for many years was a partner at Amarchand, and now writes extensively on corporate governance, shareholder democracy. He's also the founder of the India Corp blog and speaks extensively, across universities and academic institutions. The last bit, again from a governance framework, will be the merchant banker. And merchant banker obviously plays a very important role in terms of administering the entire governance framework. He's the one who does due diligence, and I think that's a very tricky role. From a merchant banker perspective, we will have Prem, Senior Vice President and Co-Head ECM, ICICI Securities. Prem has been extensively involved in ECM and actually is a super specialist in delistings. He has done 20+ delistings, and therefore will guide us from the perspective of the operational issues and the diligence issues that Prem has faced. I think broadly speaking, these are the themes that we'll be discussing, and I will be joined in this discussion by my colleague Shreyas Bhushan, who will be co-moderating the session with me. And Shreyas has done extensively worked on delistings, and maybe Shreyas, I'll just hand it over to you to lead the session now, and we'll pick it up as and when it comes. Can you just Shreyas?
Thanks, Ruchir. Thank you. Thanks for the comprehensive background, and good afternoon, everyone. I'm conscious of the time involved and the stellar panel that we have. So let me directly start with the panel discussion. And as we go forward, we can make this a free-flowing conversation. Anshul, let me start with you on the commercial picture. Clearly, this is not the first time that we've seen share prices being depressed for a couple of quarters or for a few months. We've seen this during demonetization, we've seen this during the global financial crisis, etc. But this time definitely seems different from a deal-making perspective, in that delisting transactions seem to have occupied center stage vis-a-vis all other kinds of public M&A transactions. And we find this rather interesting. And I also know that you're generally involved in stitching together some of these deals. So let me ask you this. What really is the game plan for the promoters here? I mean, what is the strategy that is driving them towards delisting companies at this stage?
Sure. Thanks, Shreyas. I hope you can hear me all right, first of all.
Perfect. Loud and clear.
Yes, very well.
Okay. Thank you. So let me start by first just laying out maybe some of the broader reasons why people look at take private or delisting. And then I'll specifically talk about what is so unique about this current environment, which might be an additional trigger, which is somewhat unprecedented in nature. So just to start with, I mean, the fundamental reason for take private is so putting pricing aside for a minute, because to me, pricing is more of a decision on timing. But the fundamental reason for why a company needs to be private as opposed to public have to do with the facts that some of the original reasons of having a public company have gone away or are no longer as important. And there are certain other more important criteria or strategic initiatives in the minds of owners, promoters, or other key stakeholders. So those, so what are they? For example, one, having the full operational and financial flexibility to do what's right for the longer term sustainability of the company, as opposed to, say, a more short term or a quarter to quarter reporting perspective, which comes in a public listed company and you have no way around it. So in a private company, of course, that flexibility is afforded to the owners by way of being able to put in more capital, by being able to do restructuring transactions, and also by being able to take certain difficult decisions which may look questionable in the short term, but they think it's the right thing to do from a longer term perspective. So that's one of the underlying reasons for, let's say, a take private. Now, some of the other reasons could also include that the parent or the promoter or the group companies actually need access to that cash flow, or more unfettered access to the cash flow of the business, which they may not otherwise have for the group's other needs, right? So that's another, could be another driver for a take private transaction. In certain cases, the driver could also be to prepare for an eventual exit, and we have seen that on a number of M&A situations, and particularly if your target potential buyer market is overseas strategics, many of them still shy away from buying a listed company and having to go through the open offer and the entire public or listed company costs that may come with that. And of course, there are synergies which are by way of reducing compliance costs, reporting costs, regulatory costs, the costs of doing the IR program, and so on and so forth, and not to mention the management distraction which happens on a quarterly basis in terms of coming up with results, etc. So these are just broadly the themes, right, where a company or the owners might be thinking of take private for over a long period of time. And then the pricing is a trigger where, as long as these confluence of factors are in place, then if the pricing is also right, where a take private is not exorbitant and too expensive compared to either fundamental value or compared to historical value, I think then that acts as an additional trigger to go ahead with that take private. Now, in the current environment, what we are seeing is that there are, for companies which always had these underlying factors, there are some additional factors uh, which are acting as commercial drivers. So what are they? One, of course, is share price. The share prices have in many sectors been uh, depressed or corrected, uh, and relative to where they were trading 2, 3, 4 years ago, whether it's in absolute price or multiple basis, it is relatively more affordable. Of course, the delisting in India, as you mentioned, is driven by reverse book building, so it's still not, there's no surety that the price that's discovered as part of that will still be attractive enough or not, but at least the starting point is much more reasonable compared to historical levels. But that's not the only reason, because prices have been depressed in the past as well. So what are those additional factors? So to me, though, there are three sort of broad additional factors which are also in play now. One is that we are in a very unprecedented situation where many of the companies or businesses have been disrupted so significantly, and given that the impact of lockdown is still not clear in many cases, that they are actually not even able to predict their next quarter, next 2 quarters, or next few quarters, and that's a big impediment as well to continuing to operate as a public company. And this is a unique situation which has not been seen to this kind of extent. Most of the situations in the past have been linked to either macro issues or liquidity issues, or as we saw in case of global financial crisis. So there were always issues linked to external factors, banks, etc. In this case, these are actually factors which are affecting the underlying business directly and in a significant way. So that's one factor which makes it an additional trigger in addition to all the factors I mentioned, not for the companies and their owners, but also, frankly, from an investor standpoint, because even investors are unable to uh, put their heads around where is the business headed in the near term, what could be the impact on the pricing, etc. So it makes it an environment where those two factors come together, where maybe it's a unique time where the owners and the investors might have a similar dilemma they are trying to solve for. Second point I would say linked to that, I think there is a much more need in this current environment than ever for doing a restructuring, a fundamental restructuring of some of the businesses, where some of the existing business models may not be viable anymore. They may need to pivot. They may need to do something significantly different just to exist. And this could be either at the company itself, the target company itself, or it could even be the case for promoter at the group level, where they may have to do some significant steps at the parent. And let's say the target company is actually one of the healthier businesses, then they actually need access to that cash flow for groups purposes. So one of the other reasons makes it even more important to do these restructurings in the current environment. And the third factor I would say is the liquidity. And by that I mean there's actually two sides to the liquidity. One is the fact that there is a significant amount of global liquidity available, and it's also available to the right Indian participants. In our view, we have seen this year there have been number of jumbo transactions, jumbo IPOs, follow-ons, block trades globally, and these are multi-billion-dollar deals. So there is no dearth of liquidity. In fact, I would say more so, and it's available from both public market side, the banks, and again, all of this disruption still has not impacted banks yet in a big way, and banks still remain healthy. So there is that financing available, of course, not local financing when it comes to, because of the restrictions on banking and NBFC financing in India, but whoever can do offshore financing, those are available. And the flip side of liquidity also is that what we are seeing is while there is abundant liquidity, interestingly, it's also becoming a lot more selective. So investors are going after the same sort of select quality names, and therefore investors are becoming more discerning, and therefore they are actually happy or ready to grab exit opportunities from some of the maybe listed names which may not fit their broader mandate anymore, and they want to rationalize the portfolio and focus more on maybe a shorter or selected few names. So both of them act as a trigger where investors may also be a lot more open if delisting or take private gives that kind of exit opportunity to the investor. So I'll stop there and see if that addresses your question.
It's interesting actually, Anshul, that you brought up price and liquidity, especially in a circumstance like this. So let me take the liberty of asking you one brief follow-up question. Yes, we understand that there are multiple factors which make a take private lucrative right now, but given these uncertain times, what are the avenues that promoters are actually tapping? What are the acquisition avenues that promoters are tapping? Because on the one hand, you have a very uncertain situation, which is impacting cash flow, etc. And on the other hand, there's excess liquidity as well. So is it debt, structured finance, pure play equity, offshore, onshore? Where exactly is the interest? And what are the key sale points or terms on the basis of which promoters are able to raise finance, especially in a post-COVID scenario or a continuing COVID scenario like this?
Sure. So, Shreyas, the answer to that really varies a lot depending on who the promoter or the acquiring party is. So let me just break it down into uh, three broad categories. One is if it is a multinational company and overseas MNC, I think they, in most cases, we have seen they would have the parent balance sheet either based on their own existing reserves or accruals, or they are also able to raise much cheaper financing on an overseas basis and bring it for this purpose to their holdco, which could be either overseas holdco or India holdco, by way of intercompany loan, intercompany financing, right? So that's one category, and it's largely driven by parents' balance sheet. We are also seeing some cases where, for example, if it is a private equity owned portfolio company and they have good reasons for take private, we have seen their LPs stepping up and been willing to fund the take private up to a certain point. So some of their big LPs would say, look, we are happy to fund you up to a floor price or a floor price plus X premium. But if the discovered price is higher and you want us to go ahead, then maybe you need to look for external funding. And in that case, again, depending on the ownership structure, there is offshore financing, offshore loan financing is still quite active and quite available. And it's kind of like a bridge financing where you do it on an offshore basis, linked to the outcome of the delisting. And if it's successful, then you close and then the banks will syndicate it. Otherwise, it's basically a bridge financing for the interim period. Now, when it comes to the Indian promoters and Indian entity, there the options, of course, are limited because, as Ruchir mentioned earlier on, you can't do bank and BFC local financing for share acquisition. Then you are left with either some of the special situation funds, or I'm sorry, is anyone hearing an echo? Yeah. So then you have special situation funds, you have private equity funds. We have also seen the special situation funds becoming a lot more active in India, and particularly, the distressed funds who do this for a living, who may not have or may have active India operations, but I think this is a very unique time for them to really become a lot more active in a long time. So there are those, there is private equity, and wherever the promoter ownership can be structured in a way there where they could do offshore funds, Again, bridge financing options are available and could be structured. One of the gray area always is that, as you know, you can't use under the financial assistant rules, you can't use companies' cash or companies' resources for delisting by the promoters. But the gray area always arises is when can you not use it, right? So you cannot use it prior to delisting, but if the delisting is successful, post delisting, you have access to the company's cash and company's resources. So that's another way to where we have seen some of the structuring being attempted, where it's basically a sort of a bridge financing, but if a delisting is successful, then you can potentially utilize some of the company's resources to part pay off, either by way of cash, dividends, etc. Of course, uh, there are a bit of gray areas that need to be thought through carefully in that kind of approach. So those are some of the options.
Yeah, that's actually helpful, Anshul, because this, at least in our experience, becomes all the more important, especially in a delisting transaction, because you don't have a cap, unlike an open offer. With an open offer, you know where you're ending. And like you mentioned, in a delisting transaction, you don't know where you're capping out. So there's some sort of ambiguity around how much of funds do you need to lock in on day one. And that's where we see some of our clients asking us a few questions on how the process works, etc., etc. But since we are on acquisition financing, let me rope you in, Ruchir, here maybe. And I heard you mention this at the start of the session as well. Anytime we get a delisting query coupled with acquisition financing, one important question that always comes up: what is the regulatory risk for a financier when he funds or when it funds a delisting offer? This is a common question that comes across. So can you shed some light maybe on your experience on how we tackle these questions and what are the solution points / comfort factors that these financiers look for before going ahead and funding a delisting offer?
Yeah, I think one question that always comes up is that how do we tie up pricing? Do we have deal visibility? And the last one, is there too much shareholder democracy? Which sort of complicates it a lot, which I don't think Hetal will like too much. But you don't even know how much capital do you need, and so how do you really tie it up? I think let's break it down and I don't want to get into too many cute structures, because quite honestly, I think we all need to be careful that this is a regulated product and with merchant banker diligence. And so, using, let's say, company funding and etc., I think all of that needs to be not just in line with the regulation, but also with the philosophy or the spirit of the regulation. But I think broadly, I think there has to be, there can be two sort of modes of funding. Either it can be debt or it can be equity. And you see, for the longest time, we have debated on what is debt and what is equity. If your debt really functions with an equity kicker, goes on to buy the equity, your redemption premium goes up and down depending on the equity price, well then historically, as you say, if it walks like a duck, it quacks like a duck, it'd rather be a duck, So quite honestly, those kind of an NCD instruments could very well qualify as an equity instrument, which is where the whole PAC risk with a promoter can sometimes come up. And even though you might say that, oh, I'm a lender, it might very well, qualify as an equity like kind of a participation and therefore PAC. So I think let's divide the debt funding, just to be clear, into two buckets. One, which is linked to sort of underlying listed equity, and the other, which is not linked to underlying listed equity. Irrespective, because you are using this debt, and I'm sorry, we always keeping in mind the foreign capital providers, so that's the perspective. And so this debt will rather be in the nature of non-convertible debentures, and if this is NCD subscribed to by an FPI, these must always be listed, because capital markets is not a permissible end use for unlisted debentures. But if, let's say, these debentures were actually tracking the underlying listed equity shares, the challenge that then comes up is that these become like market-linked debentures. And if they become market-linked debentures, there are some small requirements like 100 crores of net worth, which is pretty manageable. But I think somewhere a larger risk comes up is that they have to be rated, and not just rated. A very detailed rating kind of rationale has to be provided, which will set out a situational analysis. What happens if this was the, this is the maximum which can happen. These are the parameters, and that somewhere can get a little convoluted if the debenture pricing was extremely high and the pricing that was eventually offered was significantly lower, so to say. Even though there's a whole, reverse book building process and all, because a lot of these things go by philosophy. So I think one thing is on the NCD. We have often seen, obviously, that, because some of this lending has to be based on the underlying equity returns. And to that extent, so long as one can justify that the end use of the borrowing, and this is borrowing at the promoter holdco level, that the end use of the borrowing is not towards buying equity shares, but really towards discharge of some existing promoter loans, etc. But the returns on the NCDs by way of redemption premium are structured in the nature of equity kickers or cash flow, linked variables. One can try that, that such lender will not qualify as, in the nature of in the nature of a PAC, having commonality of objective to purchase to purchase the underlying equity shares. I think if you are not a lender, and if you are a collaborator with a promoter as a private equity fund, I think unfortunately the routes for you and the avenues for acquisition are very limited, because the moment you would want to initiate a delisting offer, you will have to first, comply with Regulation 5A of the Takeover Code, which will require you to first trigger an open offer and then indicate that it's going to go for delisting. And for whatever reason, and the reasons can be so many, if the delisting does not go through, unfortunately, you will still have to make an open offer despite the failed delisting offer. I think that sort of complicates the financing avenues significantly for the promoter. And the poor guy, he can now, banks are shut for him, NBFCs are anyways reluctant, and so therefore, what are we doing? We are really encouraging him to go to special opportunities or special situation funds who would want a mid to a high teen kind of a dollar return, or let's say a 20% IRR kind of a lending, which gets even more expensive because there is no, if there were underlying equity kickers, someone could have optimized for the cost. But if there is no underlying equity kickers, then obviously the fixed cost has to be higher. So effectively what we've done is that we've increased the cost of funding for the poor promoter on one end, when he is actually giving the best possible price to the shareholders and giving them probably a pretty optimal exit. And on top of it, if there are any structures to kind of use the company funding sooner or later, I think all of that also complicates the life of the merchant banker who's supposed to do an extensive diligence on some of these kind of structures. So while as lawyers, they always, sorry, just on a lighter note before I give it to you, Shreyas, to take up some of the practical aspects, what you see. On a lighter note, they've always said that to be successful, you only need three things to be successful in a business. You need a supportive lawyer, a creative accountant, and a forgiving priest, and turns out that those are the exactly three things that can also get you down. The history is witness to that. Maybe, Shreyas, I'm going to give it to you, for some of the practical insights that you've seen in some of these transactions.
Sure. Thanks, Ruchir. I think this was actually very exhaustive. You pretty much covered everything. But since we're speaking about the plight of PE, promoter collaboration, etc., let me also maybe share 1 minute of our anecdotal experience on something on a lighter note. Every time we start a conversation on delisting with any PE entity, 3 to 4 weeks in, the PE entities unfortunately come back to us and just ask us 3 questions. A, do we have deal certainty? B, do we have price certainty? And 3, do we at least have exit certainty if the first 2 don't work well? And unfortunately, the answer to all the 3 are no in a delisting transaction, because A, you do not know whether everybody's tendering or not. So you don't know whether you're reaching the 90%, you're not, so there's no deal certainty. 2, and you're still making an open offer, then a delisting offer, etc., as a PE promoter collaboration. Two, you don't know the price because the price is again determined by the shareholders through a reverse book building process. And three, for some reason, if the delisting fails because you can't, your counter offer does not get accepted, you can't go ahead with the delisting, etc., you still have to come back and make an open offer and stay with the company. So pretty much most of our discussions with any PE promoter collaboration ends up with these three questions being asked, and that shaping a PE's mindset on whether they want to enter into a collaboration like this or not. I'm cognizant of the time, so let me just switch gears here and let me move to the next big theme that we're focusing on in today's event, which is the role of the merchant banker, one, and governance issues, two. Prem, let me start with you here. Uh, Clearly, everybody is aware of the fact that the delisting regulations have a mandate. They provide a mandate to the merchant banker saying you need to conduct a due diligence. You need to see if there have been any undesirable, unwarranted transactions in the past with the promoters and related parties. And then you need to confirm to the board, which they will rely on, saying none of this is a problem. You can go ahead and you can initiate the shareholder approval process. Now, you've been part of multiple delistings, and let me ask you this straight up. What really are the focal points for a merchant banker when they look at a mandate like this? It's a sweeping mandate. They need to cover and enable the purpose of the legislation, cover all the ground as well, which is intended to be covered. So what really are the focal points from a merchant banker's perspective? One, and what are the good practices that you tend to follow to make sure that you've given full effect to this purpose of the law under the delisting regulations?
Shreyas, thanks for that opportunity. And basically, from a merchant banker perspective, I think there are a couple of things that we look at, especially the responsibility which comes across from the regulations per se, the delisting regulations. One is that I think we were involved right from the start when delisting regulations started off in India and till date, and we have been very active in the space. And when we are looking at this delisting regulations, I think they have taken a lot of amendments which have come across with changing times. So one important amendment which has come and which you were talking about is especially on the fact that the merchant banker's role as far as the company is concerned, the target company is concerned. And basically from this particular fact, what happens across is that we are responsible for a number of declarations or confirmations which we give across to the company. The first and the paramount being that the promoters trade, the promoters, what they have traded across over the last couple of years, at least 2 years is what SEBI prescribes across. But at least from a banker's perspective, from an investment banker's perspective, I think we look at the entire stretch of the share capital which is built up of the promoters to understand that whether one is how his capital has got built up, what are the transactions which are there as far as the buildup of the capital is concerned, and later on, in case if the promoter has sold stock. So there have been instances in the past, especially in MNC companies, when they had to comply with the minimum public threshold that they had to undertake an OFS. And in this OFS, which is the secondary sale, they have sold across on the market. So whether they have used this type of an OFS mechanism actually to dilute, what has been this, or they have been a clear-cut stake sale. So this is completely on the promoter side, understanding how is the build-up of the capital and how has the capital gone down in case if the promoter build-up has gone down. So both of this we analyze, we give it across to the board in the form of our confirmation based on our diligence which we have done across on the entire build-up of the capital. The other important aspect which SEBI requires a merchant banker to do and certify is the holding of the top 25 shareholders. So from the day the promoter entity intimates to the target that it has got an intent to delist, we go behind for a period of almost around 2 years, which is prescribed under. We can. Sorry for that. So what I was saying is that basically on the front of the top 25 shareholders, how the build-up has happened or how the offload has happened, and understanding whether there is any linkage to the promoter entities on this top 25 shareholders. I think this is what we exactly look at and certify as an investment banker is concerned and give it across to the board where the board takes this on record and gives its recommendation for a delisting offer.
Understanding. I think we have two parts here typically. One part is to identify whether, especially when we look at it from a governance perspective, one part is we see whether there are any undesirable transactions or not in the past. And I think you've clarified what the process is from a merchant banker perspective to look at this. So some of the cases that we look behind ECE, Fresheners, Kabi, etc. I think the observations juxtaposed against what you've said will make complete sense in terms of what the merchant banker's role is. Let me now maybe, Ruchir, I think this is the time when we pick up one of the hotly debated issues right now, which is on the governance. And maybe I'll let you take this over from here with Hetal and Umakanth. And we can have this as a free-flowing conversation maybe on what really is the issue that has come out right now about rectitude, about initiating delisting in a downturn, etc. So over to you, Ruchir, on this.
So Hetal, I think a lot of people are expecting a lot of spice, on this from you. So let me ask you a little tricky question, right? I think pretty much you are the custodian of retail investors, institution, and as a proxy advisor, you pretty much guide people, and there is always a critical perspective that you bring to the table. One question that I had is, isn't it true that it's by design that the delisting regulations merely say that the board of directors shall certify whether it's in the interest of the shareholders or not? They could have prescribed a much higher standard, a fairness standard, or any other standard like, in Singapore or under the Takeover Code. But they merely say that the board of directors shall merely certify that it's in the interest of shareholders. So doesn't it imply that they believe that shareholders are already of significant maturity and they can decide for themselves, and listen, board, you're just merely a rubber stamp and nothing more than that. So so what is your role when you look at some of these decisions, and somewhere can someone say that we are being over prescriptive when the law gives complete power in the hands of shareholders? Let them decide whatever they are deciding in terms of pricing. Where is the need to sort of have a hand of God on them? Yes.
Okay. So I started off by saying that there are two parts to the entire delisting process, right? One is just should the company delist, and the other one is then to look at pricing. I think a lot of the conversation now has been from the perspective of companies or intermediaries in terms of the delisting process and the regulation, but this is really the angle for investors. If you break up the sort of argument into two pieces in terms of saying should a company delist, and there is no real right answer. At some level, we feel companies which are well governed, for them to delist is not necessarily good for the capital markets in their entirety. Companies which are not so well governed, if they delist, possibly is actually going to be better for the markets. But having said so, there is, to my mind, a role that the board has to play. Fundamentally, we don't believe that regulation needs to be prescriptive to a point that they need to tell the board exactly what they need to examine. I think boards understand that there is a fiduciary responsibility, and even while a company is being delisted, I think there is a role that the board plays. The fundamental question that the board needs to ask is, why is the company being delisted? If you look at it, if you break up the entire piece, right, you're saying that, let's say there are MNCs in India which are listed, and historically these MNCs were listed because of regulatory compulsions. They possibly have the only listed subsidiary will be in India, and globally it's just the parent which is listed, or sometimes the parent is even unlisted. Is there a reason for them to delist or a compulsion to delist? Yes, one could argue. Like Anshul talked about the fact that the environment is changing and there is no visibility of, let's say, the next 1, 2, 3 quarters. There are structural changes which are happening, and therefore businesses are getting disrupted. And does it make sense, therefore, for companies to delist, reevaluate their entire business model or their even service offerings, therefore will it make it easier for them to operate as a delisted company? Sure, there's an argument. But to say that, let's say there is compulsion for the promoter, simple access to, unfettered access to cash flows because of, let's say, debt at the group level, or some of these kind of issues which are driving a delisting, you have to ask the question of whether that is really in the interest of all shareholders, or is it better for the company to remain listed and shareholders participate in the future growth of that particular company. Again, when we look at the board's role also changes, or at least it manifests substantially when you're looking at the entire structure of the reverse book building process, right? The reverse book building process is unique to India. You don't see it in most of the other markets. In most of the other markets, there is a valuation which is put on the table. The board decides whether the valuation is right or wrong based on an independent assessment, and then the delisting entire the shareholders vote on those transactions. There are different thresholds for transactions to pass. The reverse book building process gives the shareholders the ability to decide what is the right price. But having said so, it doesn't mean that the board simply therefore let off saying there is a structural protective mechanism for investors, and therefore, investors are free to decide. I think the role of the board also comes where you're looking at, let's say, in these times, the floor price, when you look at the SEBI mathematics and the calculation, can be significantly lower than, let's say, even the book value. So therefore, the board has to have some commentary on whether the floor price is low, is it appropriate, and what is an appropriate range. And I would say that more so in extreme cases, when the going is good, things are far more steady. I think that there you find investors may have the acumen to, sort of bid and come out with an appropriate price. At the other end, you also have to look at what is the shareholding structure. So where you have a higher institutionalized shareholding, you're likely to see a more discerning set of investors, and therefore the price bids are likely to be far more discerning and closer, one would expect, to the intrinsic value of the company. Where you are seeing a larger set of retail shareholders, for them to expect them to undertake that kind of a exercise in terms of determining the value and then going and then bidding is a bit of a challenge. And most of the time what tends to happen is that the floor price then becomes the anchor price, and bids tend to navigate around that. So therefore the role of the board has to be seen in context to the entire sort of structure. And to simply say that they can let go of their responsibility and say there is a bidding process, shareholders can take care of themselves, I think is possibly too limited in terms of their roles and responsibilities. I hope that answers that question.
So yeah, no, very well. So Hetal, I think one attendant question on that, right? I think even the most basic laws, they just notified Section 230 of the Companies Act, subsection 11 and 12, and they prescribed the fair pricing threshold there. They have under 236 also prescribed, and even under 230, they've prescribed the grievance mechanism. If any shareholder is unhappy, there can be grievance mechanism, go to the tribunal, the pricing can be adjusted, so forth. Why is it that none of this finds a place here? And if I can just quote from one of the judgments, it was one of the recent Supreme Court judgments of US, where they said that it was a very path-breaking LGBT judgment, where they said that sex discrimination will also now include sexual orientation. So if you discriminate on the basis of sexual orientation, that's also same as sex discrimination. And there was an interesting dissenting judgment, and the dissenting judge said that it's very good. I think logically it's a great argument, but is this what the law really intended? Because if the law really intended, then they could have added, these kind of protections here. So I think somewhere the question is that from like in your discussions or somewhere, is there any policy change that you believe should happen, or you believe the policy is adequately covering this issue, where there should be some kind of a like a fair pricing mechanism to be, to be advised, or there should be a kind of a grievance mechanism somewhere to be advised, something of that sort, right? And also board of directors should be required to actually not just say that it's in the interest of shareholders. Who is the board to say it's in the interest or not? right? You can recommend that it's good for you or bad for you on so and so reasons. So do you think there's a change needed in the policy framework, or do you think the policy framework is adequately captured and we really need to read between the lines to interpret it?
See, look at it this way, right? In a utopian scenario, if you had regulations which actually protected everybody's interests, you would argue, therefore, there is no need for a board, and board does not need to have fiduciary responsibilities. That's not the way it actually works, right? You may have structures and you may have mechanisms which are there to protect several interests. Some of them will is also a fundamental sort of reality about all regulation. But having said so, right, the role of the board, therefore, is to manage all these pieces outside of regulation. Governance starts when compliance ends. So it's not about having, the law prescribe what the board should do. There is a fundamental role that the board needs to have. It is a fiduciary responsibility towards all stakeholders. And therefore, in our opinion, the board, while yes, you need to meet the compliance standards, should look at its role in a much larger context than simply fixate on what the letter of the law says and whether it's applicable in this particular situation or not. So I think that's the way I would look at it. That's the only. So it's essentially saying that, are you doing the right thing for all stakeholders? And it cannot be driven by what regulation says in terms of what you should and what you should do, right? The regulation is not telling you what you should not do. It's not simply saying that you can't do ABC. It's saying what you should do, which I would consider would be the bare minimum threshold.
Right. So governance starts to compliance ends. Yeah.
If I may just add to that, Hetal, I think somewhere, just thinking out loud on the other hand, this concept is widely discussed in the US, and I think we've brought this down from a legislative intent in India as well. There is a board democracy and then there's a shareholder democracy. And once you start reading into the legislation, the way it's enacted, it does look like the legislation is very clear about where it wants the board to say something and where it wants the shareholders to have the finance. For instance, in a takeover, you don't have any shareholder approval, so to speak, and you have the board, independent directors in a tender offer sitting, deciding the price, whether not really deciding the price, giving an opinion on whether the price is fair or not. Whereas this is conspicuously missing. And the ball has been moved to the shareholder court, it seems like on purpose, because you take any other transaction, a pref allotment, a QIP, an open offer, you have a mechanism by which there's a valuation report that supports it, there's a process to ascertain fairness, etc. So I think a small yes or no question, or maybe a brief follow-up question to that is, was this conceptualized to be a shareholder democratic provision? And are we reading too much into this to make this a board democratic provision, saying board is to guide the shareholders?
No, I think this must be, when you're looking at delisting, when the company listed, right, it raised capital from external shareholders. When the company is delisting, therefore, there is at some level the role of shareholders as well. I think in this particular construct that SEBI's got in terms of the reverse book building process, it's actually a good construct for delisting per se. At the end of the day, you're taking away the rights of shareholders and being able to participate in the future gains of the company. Therefore, shareholders need to have a say in this entire perspective. So, to my mind, I think what the provisions which are there today in the reverse book building process today structurally is actually a good idea for delisting of equity.
Understand. But I think that
maybe yeah. So maybe let us bring you in, Umakanth. And I think you've done so much work on this, so many blogs on this, etc. Tell me from a Singapore law perspective. I think Singapore also amended its law recently. How do you look at Indian delisting process versus Singapore or other comparative jurisdictions you've looked at from an efficacy perspective?
Yeah. So I think if we look at India in comparison with other jurisdictions, a lot of what we have discussed just now comes into focus, because as many of you have mentioned, India is probably an outlier, because India is probably the only country which has given so much power in the hands of shareholders for price discovery. Whereas in other jurisdictions, it is largely with the board, and the board makes the proposal, which is accompanied by an independent financial advisor's report, like in Singapore as well. And then it is for the shareholders to decide whether they want to approve that or not. So I think the way I would look at it, if we compare India with other jurisdictions, I think in the Indian context, shareholders are an essential part of the price discovery process within certain parameters such as the minimum floor price and so on. Whereas if you look at other jurisdictions, including Singapore and elsewhere, the board has much more responsibilities, the board has much more onus, and they also have to be supported by the report of an independent financial advisor, which says that the price is fair and reasonable. So it may be an argument, we can argue which one will help discover the price better. On the one hand, you might argue that the Indian process helps better because shareholders are actually in the driver's seat in that process. But my concern with that is there is always going to be information asymmetry. The promoters and the directors will probably have a better idea about the value of the company than does the shareholders, no matter however sophisticated the shareholders are. We can mitigate or minimize that gap, but we cannot ultimately eliminate that gap altogether. Whereas in the Singapore and other contexts, the focus and the onus is on the board. And of course, if something goes wrong, there are very detailed duties on the board, which are absent in the delisting regulations in India, as was rightly mentioned. And then, the board can be called into question as to why they made a decision whether to delist and why they accepted the independent financial advisor's report to decide whether the delisting is fair or not. So in that sense, I suppose it's less prescriptive. There is an argument that maybe price discovery process may be more meaningful because it is driven by the board itself, but subject, of course, to duties that are imposed on the board. So where do we go from here? In a way, if you look at it, we are coming from opposite ends. Other jurisdictions are more board-driven. India is more shareholder-driven. So my own suggestion would be maybe we need a combination of the two. At one point, I think SEBI has come out with a lot of reforms, and it almost seemed at one point that the reverse book building process was not something that was acceptable, but I think it has been here to stay. I'm not sure if it's going to go away. So maybe it is something that SEBI and the market should continue to embrace. But as Hetal said, I think we need to impose more duties on the board itself, and maybe even require that there be a fairness valuation that the board has to consider and recommend to the shareholders, like there is in the takeover code. That, I think, it's not a solution to everything, but I think it streamlines the process. It brings in a lot more transparency into the process. It reduces the information asymmetry that I mentioned and helps the shareholders discover the price better. Maybe it may be a bit overwhelming and a bit of an overkill, but I think it will definitely help enable the process as such. But one of the things I want to also mention relating to India and other jurisdictions is, in other jurisdictions, there are board duties, there are detailed duties imposed on the directors. But we must also remember that many of those jurisdictions, such as, for example, the US, are heavily litigious. Shareholders take directors through derivative actions to courts or direct actions all the time. We've seen less and less in India for multiple reasons, delays, problems with litigation, lack of contingency fees in the Indian context. So while we must recognize that it's important to put these duties on directors, have all these statements coded into the regulations, whether directors will be sued, are we going to see litigation in relation to delisting? I have my doubts. The SEBI is going to go after if there are breaches from a regulatory perspective, but unlike other jurisdictions, I don't see a scenario where we will see a lot of litigation driven by shareholders. I think, or activism from a litigation perspective, I think that's going to be quite limited. So my own suggestion would be some kind of a combination going forward. And even if regulations don't change, I think from a governance perspective, nothing prevents a company from adopting all these measures anyway. In terms of good governance. So even though the law doesn't say so, it's always a good thing for boards to embrace these measures, maybe take a more detailed view, recommendations to shareholders, take an independent opinion from a financial advisor. These things can always take place, even though the law currently does not require the boards to do so.
So Umakanth, a question on that, right? I think Singapore imposed this IFA advisory recommendation report only about last year, right?
Yes.
Before that, there was no such requirement. In fact, more so, there was only a concept of interested parties not being allowed to vote, and the concept of offering, like the PAC kind of a concept, the offer concert parties has also been brought about only last year. So tell me, before this, was it really on sort of board discretion, and were boards sort of doing it on their own, seeking such kind of advisory opinions, or how is it happening? Because India seems to be double whammy. We neither have a fair valuation nor we have board standards.
Yeah. So there were two important changes that came about in Singapore last year. One is the question. So we can think about it as whether to delist, and then secondly, what about the price? On the question of whether to delist, ultimately the shareholders have to decide. And in Singapore, the previous law was you only required a shareholder resolution where the promoter could actually vote. But in the recent change actually eliminates the promoter from the voting process. So it's effectively a majority of the minority requirement, and it requires a special resolution. So in that sense, I think it makes it more independent from the controlling shareholder. And the second, I think, is the point we talked about in terms of pricing, where the previous requirement was that the independent financial advisor has to certify that the price is reasonable. And reasonable is much more subjective. It depends on the circumstances of each company. It depends on the shareholder. It depends on liquidity and so on and so forth. But the new requirement in Singapore is the independent financial advisor has to certify that the price is both fair and reasonable. So reasonableness is much more subjective, whereas fairness is you look at the value of the company and then you determine whether the price that is being offered is consistent with that value or not. Now, there could be a debate about how do you arrive at value, from a fairness point of view, but I think the gap is going to be much less than the previous law, which only required it to be reasonable. Now it has to be both fair and reasonable.
Interesting. I'll just, Jim, I think it will be interesting to see how you differentiate between reasonability and fairness. But, clearly the IFA report will be very helpful. On reasonability, I just want to share one thing in light of it. Sometime back, we were in some conference and someone asked Nishith that we're a very expensive law firm. You should be reasonable. And he said, oh, we may be expensive, but we're very reasonable. It only means there's a reason to charge, So I think somewhere, whether it is reason or reasonable or fair is, I think, something that will, we would love to see. I think it's a recent amendment. Let's see how it goes. Last point, maybe, and I think we're exceeding time, but last point, I think on squeeze outs, that is kind of becoming a challenge. And, Hetal, Umakanth, and Anshul would want your comments. Obviously, we had the section 236 earlier, which was not that efficient, required at 90% threshold, and there was some jurisprudence that it can only be on schemes and amalgamations, and the terms or for any other reason should really be seen in context of Imaginarium. And it didn't really take off that well. Obviously, there was a lot of squeeze outs under section 100, the new section 66 of cap reduction, which really used the balance sheet of the company to do selective squeeze outs, and pretty much most of the judgments went in favor of selective squeeze outs, whether it be Cadbury, El Pro, Sandvik Asia, and so on and so forth. And now there is the new section 230. The private unlisted company takeover, and this is obviously post the delisting when the shares are delisted, that it will apply, which I think seems a little more efficient. And as much as you can squeeze out with the approval of the NCLT, the minority shareholders with a 75% shareholder approval threshold. Do you feel there is any from a squeeze out perspective, are there any comments, Umakanth, Hetal, Anshul?
Yeah, maybe if I can go, I suppose from a squeeze out perspective, the way I would like to look at it is all the problems of delisting that we just spoke about, all the decision making apply in a squeeze out, and maybe even more, because in a delisting, perhaps the argument is at least the shareholder has a choice, but in a squeeze out, shareholders don't have a choice at all. So to that extent, yes, in the past, as you have rightly said, there have been other methods that have been used, like reduction of capital and so on. And even though the courts have allowed it, there is a fair amount of criticism that it is not fair in a sense, because the threshold requirements for shareholder protection have been minimized in those kind of methods. So to that extent, maybe a streamlined version like the new provisions that have been introduced may be useful to look at, but again, it's probably still too new, and we might know only in the way it operates. And I think what is most important is how NCLT is going to view these things, because a lot of ultimately supervisory jurisdiction has been left to the NCLT. So the practice is what we might have to wait to see.
Got it. Anything
Just
on squeeze outs? Yeah, Anshul, go ahead. Yeah.
No, I think I would just agree, and I would add that while the Companies Act has allowed it, what's still not seen enough is in practice how it's going to play out, and also given current situation where NCLT from a operational standpoint has a big backlog and there are disruptions because of COVID, etc. So that whole practical aspect is yet to play out properly. But I think it's a much better provision that at least is allowed now in Companies Act.
Yeah. Perfect. No, I think that's probably the only increase that, in selective cap reduction, you were using the company's balance sheet here. In this new provision 230, you're using the acquirer's balance sheet. But again, this is, subject to, both of them are subject to NCLT approval. And I think hopefully if there could be something like a compulsory acquisition regime, provided the pricing was fair, I don't know, would have been good. I don't know, Hetal, you would disagree maybe with that if it was automated and not sort of regulated by the tribunal. But it is what it is. I don't know if you have a quick comment, maybe just quickly in a minute, you can share, or we can just quickly take up a few questions from the audience.
Leaving aside the provision, the technicalities of what the law sort of talks about, I think when we are looking at least delisting, I think once you have a 90% acquisition, there should be a provision to squeeze out, and minority shareholders need to give in their residual shares to the promoter. We've seen enough instances where shareholders have held companies to ransom, and philosophically that's not something we believe. We believe the process should eventually be efficient, and once the price is discovered and the price is agreed upon, everybody needs to exit and allow the delisting to be complete. On the technicalities, I think as everybody's been discussing, we still have to see how it actually operates. But by and large, from a philosophical standpoint, I think this is where we stand.
Okay, so I'm great. Thank you, Hetal. I'm just going to take a few questions. Maybe this one is important. I'm sure maybe this one will be for you, from Ashish Gupta, saying that, hi, if a special situation fund or PE fund provides capital for delisting, how will the promoter provide an exit to such funds? Generally, it's an IPO or a promoter buyback or secondary sale. What are the typical ways in which such exits have been orchestrated?
Yeah, no, that's a very good question. And look, when it comes to some of the special sits fund, I think their main agenda, they operate it as a debt or as a quasi equity, but largely debt with a high IRR type of instrument. So for them, the agenda is really not looking at a significant equity kicker or upside. That may be more relevant from a private equity standpoint. However, as discussed in the session earlier, there are way too many practical challenges for a private equity promoter combination to work, just given so many uncertainties involved. But on a purely theoretical level, once you've delisted, and if it makes a strategic exit easier, because earlier it was difficult to sell a listed company, let's say. I mean, that's one additional or more practical avenue which does open up as opposed to a listed company.
Shreyas?
Hi. So I think one of the questions, maybe Prem can take this up. Prem, are you on?
Yeah,
I think one of the questions that comes across, and I think we've had this on our Q&A as well, is how do you ensure deal certainty? Is there a way to ensure deal certainty? Is there some sort of an informal check that the lead managers can do? Will that fall foul of the merchant banker check? Or is there some form of deal certainty that can be assured, or are we walking a very tight rope?
Yes, to answer to that particular question, I think in a delisting offer, deal certainty cannot be ascertained till the last moment. And just like I think what Hetal put up very rightly, one is basically on the shareholding, maybe because in case if there are large institutions which are holding in the particular stock, there is some sort of visibility that effectively it can come in. But after even the 90% can come in, the other problem which can come across is on the pricing part. So I think from purely a deal feasibility perspective, I think in a delisting offer, nobody can actually ensure that.
Understand. Ruchir, you want any other questions? I think we are running short of time.
Yeah, there are so many. Yeah, let's just take 501. I think this has been answered, but I'm going to haven't promoters abuse the process of delisting on purely opportunistic timing? Shouldn't there be a component of minimum valuation threshold for reference price? Given retail investors, I think we have discussed this. I think there is a.
Let me take that. I think and maybe I'll club this with another question as well. There is a minimum reference price, just to clarify, Ritesh, and I think we had a question from Nishith as well. The minimum reference price is really a question of what you identify under the takeover code. If you're coming through the takeover code route, especially. Even otherwise, there's a floor price that gets determined. That floor price is something which is not binding, just to be clear. And the reverse book building process starts from that floor price. If there is any element of RBI, a foreign investor involved, etc., it's still the same floor price you're looking at, because SEBI has specifically stipulated this, and you will start from that floor price. Is there I think we've touched upon the question of, is it the right time for promoters to initiate a delisting, not the right time? I think there is a legal framework that provides for this. The legal framework does not exclude situations of shares being depressed, etc. So there is a rule of law today, and I think to that extent we'll have to respect the rule of law on what it protects. And unless we have a different legislation to indicate something, while we can definitely discuss on morality and probity of it, somewhere we fall short of upturning and appending what the rule of law says, and we respect it. So there is a system, the system provides for a mechanism, the mechanism gets followed, and ultimately the ball is in the shareholders' court to decide what the price.
I think there's another question that are boards taking independent financial advice with respect to valuation? Are there any examples of such governance being followed? Hetal, Prem, maybe you guys could just guide on this, if you've seen examples of this in the market.
No, for delisting for equity shares, we haven't seen boards take an independent valuation. They do that for several years. But that's one of the things that we really want to talk about, the fact that boards should have an independent view on valuation, but we haven't seen that in practice. Prem?
Agree with you, Hetal. Unseen of, because ultimately it's the RBB process, and that's the reason I think why the SEBI has not recommended the board to look on the valuation aspect of the price as such.
Yeah. Okay, but maybe it might be chimera or hopeful to see boards sort of doing that at some stage. I think there's another question that should there be a degree of retrospective price adjustment, that could be recommended or put in black and white. I mean, obviously for the first 12 months post delisting, shares can be tendered at the same price, but is there a need to sort of build in a language to say that if there's any higher price which has been offered, then it will be retrospectively adjusted for everyone? Or is it understood that you cannot buy higher than that price? Hetal, Prem?
That particular aspect
thought with Prem, you want to go first?
Go ahead, no problem. Sure.
So there is a school of thought which talks about the fact that post delisting, if there is, a higher valuation in terms of someone coming in at a higher position. But given where we are in terms of a reverse book building process, where if at 90% of the equity be, having reached, there is a price discovery. I think the process itself allows for, a future outlook that investors can build into the bidding process. And therefore, I'm not sure I would want to complicate the process any further. I think both sides in this particular form have a say in the matter, and once the delisting is done, I think everybody needs to move on.
Got it. Okay. I think this was it, and I think there's one more. Should there be a grievance mechanism for shareholders who are not happy with, again, with the reverse book building price, and later on it turns out that the price was not fair, there were extenuating factors, something was hidden, diligence was not proper, so on and so forth?
So I think if you're talking about, things, facts not available, which you discovered separately, and these are, things which are serious issues, I think those are by exception, and maybe regulators need to step in at that point in time. But given that you already have a process which seems to allow both a balanced view, I'm not sure you need to build that in from a structural perspective, but I do think that in these kind of circumstances, regulators need to be far more proactive in being able to resolve some of these issues or address some of these issues.
And I think the last question before I end up, and maybe Shreyas, I don't know if you can see these questions or not, but there are just too many here. But the last question is, can SEBI ever take an action against the board for saying that it incorrectly advised the shareholders that that delisting is in the interest, considering the language is so ambiguous? Is it just infructuous, the language?
And I think let's maybe have Umakanth, if he's still on call, address this, because this also links back to an appraisal litigation point that we discussed offline, if you remember, Umakanth, which is we don't have a regime today, an explicit regime that codifies appraisal litigation. But given our experience last year with Fortis, etc., it may not be very far off for activist investors to start something on the lines of appraisal litigation and holding the board responsible for their actions. So what are your thoughts on this, Umakanth?
Yeah. So again, I think the question will be twofold. One is who takes the action? And the whole SEBI delisting regulations and takeover regulations are built around the fact that they will be subject to regulatory action by SEBI. So if there is any breach of these duties, then I think because they are under the SEBI regulations, the initial authority would be with SEBI to take that kind of action. But having said that, these are not things that SEBI usually does to see whether directors have acted in the interest of company or not, because this regulation essentially comes from company law. So under company law, it would normally be the shareholders who will raise these actions. And I want to make one distinction here, because under the takeover code, it clearly says that the recommendation has to be made by the board to the shareholders. So there is a relationship that is created between the board and the shareholders. So in theory, the shareholders could take the board to court because there is a privity that's established, because it is the directors giving the recommendations to the shareholders. Whereas here, it doesn't clearly say that. It just says board has to certify that it is in the interest of the shareholders. So under the delisting regulations, that relationship that is created under the takeover code doesn't seem to be established directly. So the chances of somebody going to court other than through SEBI seems less likely in this kind of a scenario. And as we discussed earlier, that kind of a litigation in any case is fairly low-key in the Indian context for other reasons, not related to this. So the answer to the question is yes, SEBI has to take the action because it's under the SEBI regulations. Is SEBI equipped to do this or not? Is it used to doing these interest of direct shareholders type of analysis? That's a different matter. Whereas shareholders may not be able to directly go to court here because that relationship of privity is not created under the delisting regulations.
Understood. I think, Ruchir, we've probably taken far too long beyond our schedule.
Far too long,
sessions.
We actually still have a good audience left here attending. All right. I think we can end this session. Thank you very much, Hetal, Umakanth, Prem, Anshul. I think very interesting comments and analysis. And thank you everyone for attending. I hope this was an insightful session. And thank you, Shreyas, for moderating this.